Welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a mediator and business valuation expert in St. Louis, Missouri. Today, I have the pleasure of speaking with Kirk Michie. He is located in San Diego, California, and the founder of Candor Advisors. For more than 30 years, he's worked with entrepreneurs, closely held business owners, and high net worth families to achieve strategic planning, liquidity investment, and legacy objectives. Today, we're talking about from one generation to the next and strategies for selling a family business, and really focus on businesses that are multi-generational. And what that means is that they maybe were started by a father, grandfather, mother, grandmother, and have kind of come through the family system. But now we're getting to a point where basically they're having to make some decisions if the rest of the family is not on board with continuing to operate the business. Is that kind of a good description of multi-generational businesses? Or Kirk, can you maybe help us out with that?
It's perfect, Melissa. It's great to be with you. And I will tell you that the first time I heard somebody refer to multi-generational families, it was in the context of wealth management. And I thought, what family is not multi-generational? I mean, they're like, we all come from somebody and they came from somebody. But in the case of multi-generational businesses, you nailed it. It's that essentially, grandparents, great-grandparents, or parents started the business. Now Gen 2, 3, or 4 is running the business, and the family has probably come together, maybe through some, tug of war, or, maybe they all harmonized around the idea that it's time to sell the business. And, it's a different kind of transaction than the many of the others we get involved in.
Well, and when we're talking about this, we're not just talking about operating businesses, because a lot of times when a family has accumulated significant wealth, then it could be multiple businesses. It could be, or it could at least be multiple entities that could have real estate. It could be farms. It could be businesses. It could be, like typically there's some sort of health issue that could come into play as well. But a lot of times what we're seeing is, these older businesses, and now they're looking at the generation that should be coming in, and all of those kids are not interested, or they're interested and they may not be capable of continuing that legacy. So when we're looking at some of these companies, what do you think are some of the biggest dynamics that these multi-generational businesses face when they're considering a sale? I think the most obvious one is that you're going to have a family that is divided a little bit, or there's a couple people that may not want to sell. But what are we, that's just what we assume is happening. What do you, from an expertise standpoint, really see what's happening?
Yeah, so we've seen a number of things that are that happen in multi-generational business sales that are common to all transactions, and then some that are really specific to multi-generational businesses. And so in the latter category, you would look at the importance of legacy. So if a business is 50 to 100 years old, and Gen 3 is running it now, and let's just say for a second that Gen 3 is capable of continuing to run it, but it's an opportune time to sell it, or everybody has decided, let's move on from that, right? So, if it were a Gen 1 business, there'd probably only be one or two people making the decisions about why they wanted to sell and what defined for them the right kind of outcome. But in a second, third, or fourth generation business sale, a lot of times it's supporting multiple people. It's not just supporting one family, it's supporting a bunch of families. And not everyone is going to have the same viewpoint about whether it's the right time to sell or not. Not everyone is going to be okay with giving up their current distributions and running certain expenses through the business and just getting a pile of cash. not everyone is going to feel like they've had their, like they want their shot at running it. If the current, group isn't capable or no longer wants to run it, maybe it's my turn to run it. And none of these things happen when an entrepreneur starts a company and 30 years later, as the sole, member of the LLC or sole shareholder in the S Corp decides to sell it. It doesn't matter whether the chief operating officer thinks they could do a better job of running it and the business shouldn't be sold. The owner is selling the business. But in a multi-generational business, you have this stuff that, kind of leaks out at Thanksgiving meals about like who should be doing what. That doesn't happen in a first gen business sale. And then there's also the people who worked for the company before the current generation even started running the company, maybe even before they started working in the company, right? So you have people that have kind of more of the tribal knowledge of the history of the business than the current generation that's operating it and is interfacing with the transaction advisors to sell the business. And, so you're going to have some opinions there too. And that's what I mean by legacy. I don't necessarily mean, kind of the name or the community impact or the numbers of people that are employed. It can be all of that too. But I mean, kind of the institutional history and the numbers of other families that are also affected by this. And all of that makes for trickier dynamics and more nuanced conversations, and probably requires a lot more skill from the advisors to get that right. So getting like price terms and legacy control might be relatively easy, but getting all those other pieces right, that's so much trickier.
Well, and I think that occasionally you'll see when you have really third, fourth generation, that you also have family members that are in like related businesses. And so you have like, yes, we're running this, manufacturing company, but we also have this cousin that has a distributor that's one of our major distributors, or we have another child that is a vendor that's supplying us with some of the lumber or whatever. And so you have these, like I've seen it more complex in situations where you have a primary company, but you have all these ancillary companies that the buyers, like if you don't really adequately disclose or even understand, right, like how complex some of these things are, that when the buyers come in for due diligence or some other, and they're like, wait a second, are all these companies included in this transaction? And they're like, no, they're not. Because I think that that's what I would see a lot more often is a main business owner is saying, well, I'm just trying to sell this sliver of the company, but it's not all of the pieces that make this company whole.
Yeah.
Have you seen some of that happen as well?
Sure. You'll often see it happen where, let's say, the family owns the real estate that the company operates in. And in the transaction, there's not going to be a sale of the real estate, but the company's going to sell. And then how's that going to impact the real estate? Because they've never had to be true property managers. They've never even had to hire a property manager. They don't have to worry too much about whether they're charging market rent, above or below market rent. In fact, sometimes they're adjusting the rents to do what's best for the company, or adjusting the rents to do what's best for the distributions from the real estate company, right? And so you have those considerations that can happen, with a single owner first generation business, but are much more common. And then to your point, oftentimes, whether they be in the direct line of the company or connected to the company, like you mentioned, kind of the cousin thing, you're definitely going to have kind of what I would call friends and family, kind of one kind of standard deviation or two outward from the business, where you'd call that legacy too. And it's not always like, a best in class provider, right? And so, private equity firm comes in, they may not know anything about the operating elements of the business, but, like most private equity firms, they think they know everything about everything. and they start blowing out relationships like crazy, or they start making, you don't know that, Uncle, Jack was the insurance broker for the company and doing all their healthcare and benefits forever. A private equity firm comes in, they look at it and they say, well, we've got a broker that does 14 of our other portfolio companies, so we can get additional consideration. We're just moving it over there. Now, Uncle Jack only had one client, and now Uncle Jack has no clients anymore. And the family's going to get the blowback there. And Uncle Jack's going to expect to get something out of the deal, right? You just don't run into that kind of stuff. And it's not all bad, right? Sometimes when a family comes together and decides that the right thing to do is to sell the business, that's the right way to treat the family's legacy. That can also be really, really strong, because if you get that in the hands of the right buyer, they get all of that institutional goodwill that comes along with the company name and the company's reputation and how meaningful the company's been for a community, right? So it can be, you can get intellectual property or intangible assets that are even bigger with a multi-generational company than you can a first generation company. So it's not all bad. It's just more nuanced. It's always more nuanced.
Well, and it's interesting because you talk about, because I see a lot of companies that will sell the primary operations and then have like a lease to buy or an option to buy the property at a later date. And the interesting part is, if we combine a little bit of valuation here, is that when we're doing the valuation for a company that they're contemplating sale, there are questions around the rent expense and the owner's salary. And these become pretty important in multi-generational or even any company, because, and what I like to say is, obviously we want them to be fair market rent, right? And a reasonable salary. But I also just encourage the person to think about, that's what the buyer is going to see, and that's what the buyer is going to assume is going to continue. And
Yeah.
so if you've arbitrarily made it too low so that you can show more profit or show more EBITDA, it could come back to bite you, because then you're going to be like, well, wait a second. I want you to pay double rent. I want you to pay double salary. And so there's this kind of equilibrium there that people need to consider. And that's more in the due diligence part, but it's a factor when you're going to end up, like, do you actually have a lease with the building that you rent? And they'll be like, no, we don't, because we rent it from ourselves. And I was like, well, it might be a good idea to put that together so that that's what would be transferable, So I think some of that is going to get into some of the challenges that we see in these multi-generational businesses as they prepare for a transition or sale. And it could be because they're also using cousin Bob to be their accountant and their financial planner, or they've been doing their taxes themselves. Like, a lot of these things could be some of the ancillary things, but what do you think some of the challenges that you're seeing as they prepare?
Yeah. So the things that happen with multi-generational, first of all, to come back to a point you just made, which is really critical about getting the lease rate or the rent right and having documentation in place, is critical. Because if you don't, buyer's going to exploit it. They're either going to adjust purchase price around the fact that they'll say, well, your EBITDA doesn't reflect the right level of expenses because you're not charging yourself market rent. So we still will pay you 8 times your EBITDA for the business, but we're adjusting your EBITDA for $500,000. So we're lopping, $4 million off purchase price. And, sorry about that, but your EBITDA is, overstated or understated, as a function of you not truing that up. So it's gonna come out. And as a seller, unless you're willing to essentially say, well, tough break, you're just going to have to pay me more, which is usually, unless you're willing to have that bluff called, that's usually not going to work out well. But, one of the other things I would say is also
that kind of leads in to, I think, the challenges for some of these multi-generation companies in general is that they're doing things that are good for the family, but may not be good for presenting to a buyer. And it's almost like you're really having to go in and clean out the closets, like clean out the things that have existed from potentially, and even like if even the company was properly transferred in the past, like a lot of times we'll find out that the owners are not necessarily the owners, and or they're different even percentage of ownership, because I had a big litigation where they thought the whole business was transferred, and it was never properly even transferred. So sometimes these kinds of things have to do with the team that you surround yourself with, but those are some of the issues that we've seen pretty prevalent.
Yeah, it's a great point. Oftentimes you will see, whether it's an S Corp or an LLC, that the estate planning has gotten ahead of the corporate documentation that should reflect what the estate planning is. So old certificates haven't been canceled, new ones haven't been issued. The cap table doesn't reflect what, grandma and grandpa's estate plan, did. And so, you get into this emergency kind of fire drill mode in the last 3 days of trying to close the transaction, when on the buyer side, they're saying it doesn't look to us like you have the right to sell the company, because it appears that there are a bunch of other people that have shares in the company, or we need to see how things have transferred, because the numbers of shares no longer add up based upon what you've uploaded to the deal room. And the family doesn't even think about the idea that, there are actual, share certificates that are going to be pulled up, when it's time to close the transaction. So it's a great point. And with multi-generational businesses, it is even more common for the estate planning to either be behind or ahead of the corporate documentation. And coming back to another point you touched on earlier with, kind of Uncle Bob, doing whatever, we have seen in multi-generational businesses, it happens in private business generally, but it happens more in multi-generational business, where like a staff function that needs a real professional in a company that's 50 to 250 employees, like chief operating officer, who's also doing HR, is really just, kind of the sister of the founder, who is the primary contact with admin or ADP, and also has the keys and is kind of the keeper of the information on logins and stuff like that. So not really a head of HR, and they're not really a chief operating officer, but they are getting paid like one. And if you've got a strategic buyer coming in and that person wants to continue to be employed, you can guarantee they're going to get blown out fast. Right. So if that's an important part of legacy, you got to kind of look at, is my C-level or my management team, the management team I would hire if they weren't related to me? And if they're not, then I better at least set aside some of the proceeds for some golden parachutes for those folks, because they're probably going to get blown out by my buyer. And those are hard conversations that are better had between the transaction advisors, the family leadership, and the people in the company, than waiting for the buyer to have those conversations with them. Because the thing, grandma and grandpa want to ride off into the sunset, and they're probably already wealthy. So it's the second and third generation that got like real money, right? And grandma and grandpa in retirement are now going to have to deal with the fact that, their grandniece got fired as the head of HR and COO, and she doesn't understand what happened. That doesn't happen in a first generation business. That person's usually, the person running it has probably been going to Vistage or YPO or something like that. They've developed the skill set or hired for the skill sets they didn't have. That gets stunted in a family business.
Well, and I think that, I've gone through my fair share of watching mergers and watching, acquisitions. And in the accounting world, companies are bought up left and right now. There's a lot of consolidation. And I think that that's always an issue, that after the sale of any company, there's a protected space, if you will. Like maybe it's 1 year, 2 years, 3 years, where nothing's going to significantly happen. And sometimes it's even in the agreements that nothing significantly is going to happen. But when you're outside of that 1, 2, or 3 years, and it could just be a perspective, right? It's not always enunciated, but beyond that, for the most part, things could be kept a little bit the same for a short period of time. But when there's going to be an overhaul, that's when you're going to see some of either the culture, a change in standard operating procedures, or a change in staffing is just going to be a natural kind of result. And so it's almost like, well, they haven't made any changes in the first year. And I'm like, do you normally see that, or do you see people come in day one and kind of change everything?
Yeah, great question. Kind of depends on the buyer. Private equity firm at some level knows they're not operating experts, and they're hoping, even though the time I've heard hope is not a strategy over and over again by private equity firms. I see them employ it, however, as a strategy, pretty common. So they don't want to operate the business, mostly because at some level they know that they can't. It's almost like, every book reviewer thinks they could be a great author, but they're different skill sets. And so they don't want to run the business. So they are probably going to spend money on scaling sales. And then, in the first year to 18 months, which is not going to negatively impact anybody. It's just going to be new bodies added to try and get out there and tell the story. And they won't start worrying about margin for 2 to 4 years. So things are going to, when they start focusing on margin and they've stopped, kind of investing in the business, they expect it to operate like an ATM, right? And get better and better, and then eventually to sell it. A strategic buyer, on the other hand, will probably have, the grandniece, who's the chief operating officer and the head of HR, reporting to HR at headquarters, especially if it's a public company. And she's probably going to lose her job fast, because she won't be able to keep up. She's not used to having to report the way you would in a big company. And so, look, there are outlier cases where maybe the family employee turns out to be really fantastic. We've worked with a couple of fantastic CEOs that were second and third generation down. You can point to somebody like Bill Ford Motor Company. I mean, arguably Bill Ford, together with a little bit of relief from the federal government, saved that family company by recognizing skill sets that he did not have and current leadership didn't have, and going out and hiring Alan Mulally from Boeing to get that done, and convincing the family that they needed to acknowledge that they didn't know what they were doing, right? But that's a rare case. That's a really, really rare case. And I think Bill Ford is a third or fourth generation Ford. So, usually so to kind of coalesce a little bit, depends on a lot on the buyer. If it's a strategic, it's probably going to happen fast. If it's a financial buyer or a competitor or something like that, it'll take a while. They'll want to leave things alone for a while.
Well, and I think it's interesting because we wanted to talk about kind of like the challenges that are different between a multi-generational firm and a first generational firm. But one of the things that I thought I would mention that I think is a little bit more time consuming and important in multi-generational that we kind of talked about prior is that you have to clean up a lot of books, records, locations, processes, procedures, depending upon the stage of the company. But it's important to kind of have this proactive due diligence process because, I think that the things that fall through the crack of that understanding the business. Like you didn't even know that the cousin owned a competitive business, because you didn't go deep enough into the due diligence to know what the buyer was going to find. Like, I feel like that's one, like a first generational business, like, it's 5 years, it's 10 years. There's not a lot of different, like they could have just gotten started and had a great idea, but these 50 to 100, there's a lot of things in play that has to get them ready for this transition. What are some of the other pieces? And I know you focus a lot on due diligence, but what are some of the other differences that we have to be mindful of?
Yeah. Another great question. Look, Candor Advisors is really proud of the fact that our law firm partners often talk to us about how much better we are at due diligence than most investment banks. And I think that's mostly because we don't really feel like our job's done until the seller has the proceeds. And I don't just mean the cash at closing. I mean the earnouts. I mean the rolled equity. I mean, we make sure they get transitioned to the right wealth advisors. We make sure that they upgrade their accountants. So we do spend a lot of time in diligence because we know what can bite our client. And we've gone into diligence thinking that we didn't need to worry too much about reps and warranties, to then finding out that through no real fault of their own, just no development of a skill set they didn't know they needed to have, that we should probably go out and get rep and warranty insurance, or have a tough conversation with our buyer about what's going to be there or what's not there or what we've discovered, right? You want to have those conversations early on. But one of the interesting things that, like in a first generation business, most of the things that are going to come up, kind of the skeletons in the closet that you were kind of alluding to, typically are HR legal related, or maybe a product liability problem, right? So, the founder might not think anything in a first generation sale of an email they got 6 months ago from a former employee that thinks that they were owed something and even thinks they developed some intellectual property like the sales process. That could come back. And the way that comes back is founder or one of their key people that knows there's a sale happening is blabbing at an industry conference. And that former employee hears it because they now work for a competitor. And they figure founder's about to get a whole big slug of money. I'm going to sue his ass, right? And so that is common enough to a first generation business that when we say any legal issues outstanding, we don't just mean an awareness that you're being sued, but we mean emails you've received, emails your people have received that will suggest it. And they say, nope, nothing. And we say, are you sure? And they say, nothing I can really think of. I mean, there was this one employee, but I think that got kind of squelched. And we say, if I told you that when you say to me, no, if I find out it's yes, you and I have just committed fraud and I'm not taking the fall for that, would you still say no? We go deeper. We definitely go deeper because they've never been through it before. So they don't know that there's no such thing as a no harm, no foul first time seller thing, right? You don't tend to have those kind of issues as commonly with a multi-generational business. One of the advantages a multi-generational business has, we've been talking mostly about kind of the tricky things they have to navigate. Multi-generational businesses in some cases are almost like ESOP companies, where like ESOP companies oftentimes have more employee loyalty. Like you're a family member, you may not be the person who would have got the job, in a highly competitive process, but you're a lot less likely to just quit the family company. And so what ends up happening with a multi-generational business that sometimes they don't really think about is what we would call kind of a sovereignty analysis, which is to say, okay, maybe we can take the business to sell it to an outside buyer for $100 or $250 million or whatever the number is. Let's look at what economic benefits the company is currently providing to all the people that get those benefits. And let's look at what it would take on a net after-tax proceeds basis with reasonable investment returns and try and replicate that. And if you can't, then maybe one of your alternatives is to say, well, why don't we not sell the company? Why don't we treat it like it's now our family office, and let's hire some professional management that, we can, it's going to cost us $1 million or $2 million a year to equip it with 3 or 4 really key senior executives to run the business, but they might run it more efficiently than we do. And we'll still be getting distributions, and we'll still be 100% owners. And maybe we give them an opportunity to earn their way in, but never really at a level of the family. So there's an option, right? The kind of what I would call becoming a limited partner in your own business, because sometimes the outright sale is just not the smart thing to do. And like I said, with a multi-generational business, it's a little bit like an ESOP. So you've got more employee loyalty. There's a flip side to that, but there's a big asset there.
Well, and I don't think I've ever really considered it that way, which is really fascinating to me because, in looking because the traditional sales model or the traditional like auction style process in investment banking isn't always conducive to these family run companies. And I feel like even in when you were talking about, are you sure that there's no issues? I don't think they're aware that depending upon how they sell their company, they're going to be on the hook for those issues after the fact. So if it comes back like, oh, no one knows about it, if it comes back that employee comes to sue you, they are coming for you now personally as the prior owner, and it's going to be kind of held in that prior state that you're on the hook. So, I think that that's an interesting concept to look at, maybe more creative ways for them to transfer the business, which is why we have some, what are some of the strategies that you employ? Because, we talk about prepping for the sale, and a lot of investment bankers, business brokers, all of these people will be like, oh, you need to prepare to sell your company. And I think companies are like, oh my gosh, what are they talking about? We just go to market. But these are some of the reasons why you really have to take it into account, because a lot of times I'm saying, would somebody pay that amount of money for the cash flow of your business? I know that there's value to you as operating this company, but is the value really going to transfer to some other owner? So I like what you're talking about in doing this analysis of how much the family benefits from it. But what are some of really also the planning strategies for a family-owned business when they're looking to maybe preserve either the name of the company, have the company continue in some capacity, and then still prepare for sale? Because it is a little different, and it does create more creative strategies so that you can actually facilitate that transaction or that sale. And sometimes the family may be sitting back and saying, well, the professionals will figure it out. Like everybody will kind of take care of that. Like, what are some of your suggestions in this area?
Yeah, this is one that doesn't get looked at enough. So I'm really glad you're asking this question, because, if you start far enough out, and I'm talking about at least 6 to 9 months and maybe more like 2 years out, there are a lot of options. First of all, estate taxes are arguably the only elective taxes in the United States. There are ways to structure around it. And currently, this is going to change this year potentially, but currently, below $25 million, your estate's not taxable. And so it's just going to pass to your heirs without them having to pay any tax on it. But above $25 million, you've got a taxable estate. And there are some strategies you can use to move that down, a couple of generations, get it out of your estate. You can create what's called an intentionally defective grantor trust. And even though it sounds like, why would it be intentionally defective? That sounds weird. It's even weirder when estate planning attorneys call it an idjit. But they'll call something a CRUT. That's a charitable remainder unit trust, or a flip CRUT, a family limited partnership charitable remainder unit trust, with an IDGIT attached to it. So start talking to an estate planning attorney, you better have your acronym hat on. But there are some strategies that, if you're far enough out, can really make sure that at Gen 1, there's less or no estate taxes. And ownership in the business can move down. And if you look at, like, a lot of this estate planning, interestingly, was done for kind of wealth advisory family office firms. Like, take Bessemer Trust in 1905. The guy that sold, he was the chief financial officer for U.S. Steel. Andrew Carnegie owned U.S. Steel. So Andrew Carnegie has this chief financial officer, Henry Phipps. Henry Phipps in 1905 gets $50 million when U.S. Steel sells. Now, in current terms, you can imagine what $50 million looks like. Well, back then, estate planning was in its earliest phases, and nobody was thinking much about it. They were thinking about family farms, but not like this. And so there were a few states that, in order to get people or companies to move there, put things in place where they couldn't put in a rule, what's called a rule against perpetuities, but they could make it okay to put something in a trust that lived for a long, long time. So I think Delaware has a 300-year trust rule, right? So Bessemer Trust, which is Henry Phipps' wealth management firm that supports like 300 living descendants of Henry Phipps, that has never had to pay estate taxes. It just, the ownership keeps moving down, and the portfolio distributions from the asset management business and then the portfolio themselves keep going out to all the descendants without any estate taxes paid. Somewhere in between creating an IDGIT for your $2 million landscape business and that, really complex multi-generational planning that, like, the Rockefeller Family Office has done, Bessemer Trust has done, and many others have done, is possible. But you got to start well before you're going to market, because it's complicated. There are some things you can't appear to just be trying to, last minute plan to avoid taxes. You've got to give it some seasoning, some thought, some delay, right? So multi-generational businesses have that option in a little different way, because the family's all kind of coalescing around that. Whereas a first generation sale, daddy wants a Ferrari, right? So he doesn't necessarily think too much about, he's been, kind of being careful about the business and all that for a long, long time. And, he wants a yacht, and he wants a helicopter, and he wants to start acquiring art and stuff like that. And you can't do that as easily if you move your money down, multiple generations. If you haven't already dealt with kind of the idea that, the difference between somebody's life with 50 million and 500 million isn't very different unless they acquire a taste for art and airplanes. If they do, everything changes. If you start acquiring art and airplanes, you can run out of money with $50 million. 500 million is harder, but, so some of the planning needs to kind of revolve around the things that a first generation wants to do because they've never experienced, and a third or fourth generation where the family's been wealthy for a long time. Yeah, they're not as inclined to go out there and do bucket list stuff.
Yeah. Well, and it's interesting because I think that more times I will see a first generation family, when you start to talk about gifting, when you start to talk about moving the company shares into even a trust so that it could be transferred upon the sale, right? Assuming that you're going to sell in 5 or 10 years for some astronomical price, it will just automatically benefit the children and grandchildren. And to see the look on some of their faces when they're like, why would I transfer why would I do that? Why would I do that?
Right.
And so it's fascinating, but it's also, I think, the mental theory behind it of what you're saying makes a lot of sense. You know, again, they like a lot of people are looking at the sale of this asset to be their retirement, to be, you know, when they finally do the things for themselves. Whereas a multi-generational firm is going to be a little bit like everybody has already protected, or everybody already has something in their best interest. Now, if like, do you see very often that the second or third generation are leading the charge to sell the company in any circumstances, because that maybe the parents or grandparents don't have the capability to even, you know, deal with that situation?
Yeah. So this one, I mean, it's not easy to paint it all kind of with the same brush, but yeah, we see it. Not always for the reasons that would seem apparent. So sometimes what happens is the brother or sister who gets the CEO title and is running the company has a brother or a sister, or brothers and sisters, who didn't get the title. And that means that there are some people that also might not have gotten the right hugs, picked up at the Little League game, or, you know, whatever else is unresolved in the family going into that gets exacerbated in a multi-generational business. And so let's say G3 and let's say oldest, grandson is running the company. Like take the Murdoch family, for example. You've got 3 kids who were not in agreement about who had the most talent and the right idea for running the business. Now, Rupert Murdoch outfoxed himself in the way he did his estate planning on this thing. So the Nevada courts have already ruled, tough luck, you can't change, you know, your trust, because it was irrevocable. It's done, you know, so now you can't change back to the way you wanted to.
Well, and this is normal. Like, this is normal. You have a business, you have 4 kids. Even if I have it in a trust, I'm going to have all 4 kids upon my death are going to share equally in the business. And now, I mean, we've had this happen where we have 3 siblings or 4 siblings, and it's like 2 of us want to sell it and 2 of us want to keep it, and only one of us is operating it or even in the business. And we think that that's a great strategy to share it among the children, but it actually creates almost like an insurmountable challenge to get agreement to do something. And then when the buyer comes in, I don't think the buyer wants to see or deal with the infighting of the family. You know, like, that might be normal for this business or this family, but a buyer comes in and they're like, I don't know if I want to be a part of this.
Yeah.
Right.
You bring up a couple of great points. So first of all, the idea that multiple family members are going to be able to kind of co-run or co-manage a business, I will say virtually never works. And I'll only say virtually never works because if I say it never works, somebody will find me one example of where it worked. But co-governance does not work. It does not work. People need different roles and different responsibilities. Co-CEOing does not work, period. End of story. There's countless examples of that. And it's even worse in a family company. You know, when Michael Eisner thought Jeffrey Katzenberg was trying to take his job, and so he fired him, and then Disney had to end up paying Jeffrey Katzenberg like $290 million in severance that helped him start DreamWorks. You know, that was there's an example where they weren't even co-CEOs. It was just Mike Eisner was worried that Jeffrey Katzenberg was trying to get his job. So, and that's not even a mommy always loved you more than me, or, you know, you always got treated. So there's that dynamic in a family business. The other thing that happens is the buyers exploit this stuff. So if a buyer knows that there's dissension in the ranks, like part of the reason that, let's say you've got spouses who co-own the business who can't stand each other, or have just kind of quietly decided, you know what, you go, you do you, I'm going to do me, but we're not going to be together anymore. And we're getting these nice distributions off the business. If you find a buyer who knows that that's happening, as opposed to thinking that they're happily married, especially if it's a financial buyer, they'll try and exploit it. They will try to get a lower valuation because the suggestion will be that the company can't possibly grow and prosper and be everything it could be when you've got two owners who've decided, you know, very specifically, they're not spending the rest of their life together. So that can't be a good model for how this company is going to move forward, because they're going to have divergent interests and the buyers will exploit it, which is why, you know, you don't want to mislead anybody. On the other hand, you certainly don't want to wear all this on your sleeve going into a potential transaction. You know, you keep that shit at home, you know, and let's get through the transaction. Then let's work all that stuff out.
And sometimes the families don't really recognize some of the toxicity in the way that they're operating. And it's not like it's like super bad. It's just that they're used to a way of communicating, a way of getting along that to an outside buyer is just, you know, a little too close. And so you set yourself up for the situation that removing all of the family after the sale is easy. It's like cleaning shop. Like they're going to keep a lot of the employees that are not related. And the other thing though is that in the due diligence process, you're going to have a buyer that's going to want to talk to your employees. Like if I'm a buyer and I see a family held business that has multiple generations, I'm probably not going to buy that business until I talk to the employees, and I'm going to be like, hey, is it toxic or is it not toxic? Because I don't want to, like, because a lot of times everybody's like cleaning up nice when the buyers come and we're trying to put on our best, you know, clothes and show everything perfectly. But the buyer still has this opportunity very close to the deal being done that they could potentially talk to your people, and it could be a deal breaker, right?
Yeah. Yeah, absolutely. We haven't had it happen on an investment banking process that we did, but we have seen it happen where we worked with the founders to get ready to sell the business and then hired the investment bankers. In two cases, we've seen it happen where, you know, that, and that, you know, we, as much as you try and coach folks, they just, humans are humans, right? And, you know, we're just going to reveal too much at just the wrong time. Nobody's like Marcus Aurelius going into it and, you know, just maintains their stoic path. And so ultimately, a lot of times where it will come up is the private equity buyer will act like they can solve an existential problem for people by saying, you know, let's say you're the selling company. Melissa, what do you really want to have happen here? And I coach my clients on never answer that question. Never answer that question. That guy on the other side of the screen, and it's always a guy, that guy on the other side of the screen is not a genie. He will not grant wishes, right? He's going to put together some bullshit structure and try and buy your business for as little as he possibly can. And if you tell him that you just want it to be done because you can't stand having like one more, whatever, oh my God, you just gave that guy a trail of breadcrumbs to pay you less for your business. So like, don't answer that question, right? And so, you know, but we have seen where, you know, a divorced or a divorcing couple just couldn't keep it together. And, you know, in the nth hour, after lots and lots and lots of meetings, one of them broke and, you know, just said a little too much. And, you know, what happened was they could have still done a deal. It didn't blow up the deal, but the buyer, I would argue in this case, probably tactically very smart, retraded. And, you know, which to your listeners that haven't been through an M&A process means they changed the deal way into the deal by coming up with some rationale that they thought was reasonable, meaning they paid the seller less. So they changed their offer even after a letter of intent was co-signed on both sides because of this dynamic, and basically said, take it or leave it. And, The client in this case was probably $500,000 of, legal and accounting fees into due diligence. They wanted to be done with each other, which is why, they blew up on the call, and they went ahead and took less for the business, and ultimately, said, well, so be it. I get to be away from him, and I'm in touch with one side of that, not both. So I don't know how they both feel, but I guess they decided when it came to custody, they split up their friends and their former advisors. So,
well, and the retrade, I think, is important. If you're talking to a broker, an investment banker, somebody facilitating your deal, and they don't talk to you about the retrade, and you can call it whatever you want, renegotiate, but when you determine the price at the beginning and then you get to the point where you guys settle on the deal price, right? And you've probably taken a haircut already, and you're like, that is the lowest price I could ever go to. Like, typically, not only are you going to have a retrade, but you could have money set aside and kept back for reps and warranties, right? Mm-hmm. In escrow, for both of you to determine if it gets paid out of escrow. And so I think that keeping that in mind, that there's going to be a potential. So it could be a working capital discussion, that they're going to ding you on working capital. They could have found something in due diligence that they're like, literally doesn't mean anything, but to them it's like, oh, this changes the whole deal, and you have to kind of keep that in mind, that if you settle on a price at the very beginning and that's your drop dead price, that's not potentially the price that's going to happen at the end. And the retrade is done within maybe 2 to 4 weeks or less before you are supposed to sign on the dotted line. I mean, that's negotiation power that they have to say, you know what, you really want this deal done, then you're going to have to cut me another $100,000 off the top, or, you're going to have to do A, B, and C. And these are significant issues that I think sometimes could be talked about up front. Like, what is the holdback that you're going to require? Mm-hmm. What are some of the issues that we're going to deal with if we have an earnout? Like, how are we going to calculate? But there's always going to be a renegotiation. And so, especially if you deal with a sophisticated buyer. That's so right. If it's unsophisticated buyer and seller, well, that's probably the worst deal ever, because you're having to educate everybody on the deal. But
that's hardest on the advisors for sure. But one of the things we tell everyone, whether they're reaching out to us because they got an unsolicited offer, or they want us to help them prep to go to market in 3 years, or they're ready to go now, there's a few things that we tell everyone because they're common to all deals. The first one is that, the final price will be at least 20% higher than whatever the initial offer is. And in a competitive process, sometimes 20 to 50% higher, right? Especially in a market like we're in now. So an unsolicited offer is never going to be the best possible deal you can get. Doesn't mean that's not the right buyer. You might be able to get them to move up a little bit by giving them information about what looks like market, and explaining to them that rather than go to market and do a competitive process, you'd go exclusive with them right off the bat if they got up to market. But we tell everybody, do not accept an unsolicited offer. Never sign an LOI until you've gotten guidance. LOI is a ceiling. It is not a starting point. It is a ceiling. So be aware of that. The other thing we tell people is that due diligence will feel invasive and accusatory, and it'll be unpleasant the whole way. And you should choose your advisors partly on who you can hear bad news from or who you can be in contentious meetings with, because they're going to be your buffer on diligence. And you don't want to shoot the messenger. So if you don't like your advisor going into due diligence, you're going to hate them by the end. You might hate your advisor more than you hate the other side who's making due diligence difficult. The other thing we tell them is that, between willing buyer and seller, valuation is usually not the problem. Gaps in valuation that are not too big can be solved by structure if you got a willing buyer and seller. And what we tell them is, think of the paradigm: seller's price, buyer's terms, buyer's price, seller's terms. And every single negotiating point just needs to go back and forth that way until you've wrung out everything, right? So you say you won't take anything less than $20 million for your business. And I say, no problem. I can give you $8 million in cash at close and $6 million each in rolled equity and an earnout. And you say, no way. If you're going to give me rolled equity and an earnout, I need to get at least 24, and you're going to have to bump the initial cash up. And I say, well, I can't bump the initial cash up, or I can't give you 24, but I could give you 20 and I can make it 12 million in cash up front and 8 million in rolled equity, and we'll just scrap the earnout. And you say, okay, we're still at 20. I got better terms, right? And you don't wring that out. You don't kill it. I mean, you don't make everyone hate each other by the end of it, but that's how you get to the right price and structure. And then you learn a lot about whomever you're doing a deal with in due diligence, and believe who they show you they are. Believe who they show you they are. They won't get better when it comes to owning your company. If you're doing a majority recap or a full sale, do not expect them to improve. This is a clumsy but accurate analogy that whomever you're dating will not become more considerate and thoughtful when they're married to you, right? The dynamic is very similar there. So if they're assholes in due diligence, they're going to be worse as owners, right? Well, if you're okay with that, because you're getting enough money, recognize it. Right? You don't need both. If money's going to solve for it, maybe you can even have some therapy and nicer vacations because you sold your business to some jerks. That's fine, but just recognize it.
Well, and I think that those are all really good advice. I think what I would layer onto it is that going in to sell your business, you cannot take it personal, and you have to surround yourself with people that can buffer when you do take it personal, that they can rationally tell you whether you should take it personal. Because I think that it's very disarming to have somebody come into what you believe they're going to come into and be like, oh my God, this is the best business I've ever seen. Let me hand you a check. Yeah. And you have to understand that there's the psychology of negotiation is they're going to come in and be like, oh, this is a great company, but all of these things, because they're already positioning for that sell price that they have in their mind. The other thing that you said is the red flags. And this, I think, happens more often than not, that you'll have a buyer come through and they seem like a great buyer. They're either a known name, strategically, like somebody that you really want to buy you. They have deep pockets. If they or any buyer starts exhibiting bad behavior, like that's not for you to question. That's for you to note it is a red flag and you to determine if it is more likely that you will still result in a good deal, but it is literally the flashing red light to you to say, okay, if they're going to, and again, and what I look at is if the red flag is in negotiation techniques, if it is in trying to trick you in some way or kind of manipulate, like this is a person that you're going to be in bed with for quite a long time. Even if you think you're selling your company and walking away day one, you're not. Yeah. Right. And so in some capacity, I think what you said is very key on that. What we do is we hope the buyer's going to get better. We hope that they were just negotiating hard at the beginning. That's not the case. They're usually telling you exactly how they're going to operate in the deal. And if they pushed you hard in the initial negotiation, they will try to murder you in the retrade. Like sure. They will come guns a-blazing because they won't have that niceness of the beginning of getting to know you. Like at that point, they're like, I never wanted to pay more than this. I don't plan to pay more than this. I've just made you go through this whole deal so that you are forced to continue on. Because no seller wants to stop a deal 2 weeks before they sign on it. So I think my advice typically is to business owners is the same thing that you probably tell them, like, you do not have a deal until that money is in your bank account.
Right.
I don't care what you think you have, and do not get set on spending the money before it hits that bank account, right?
Yeah. Yeah, just look, behaviorally, one of the things that happens there is that buyers are used to doing that, right? So they're less invested in the outcome. They might now they're late in a deal. If you've got a big public company or something like that, and every Zoom call, their accounting firm had 8 people on screen and their law firm had 17 people on screen. You can bet they're $1 million, $2 million, maybe $3 million into due diligence. They're not going to pull the plug in the last week to try and eke out, a few $1,000,000 on the working capital thing. On the other hand, if it's early in the process and they start showing you that kind of behavior, you are spot on. That's and you just shouldn't assume that that's going to happen, because if you've never sold a company before, you start counting those chickens before they hatch as it gets closer. Yeah, I mean, look, you're doing planning with your accountants, maybe talking to a wealth manager, but don't shop for cars. Don't shop for fancy watches. Don't look to upgrade your house until that's happened. And then when it's happened, okay, there will be plenty of time to deal with that, because the buyer can exploit that too. If it's a financial buyer, they go through processes like crazy. They're the best investors from a private equity standpoint are really, really passionate about process and valuation discipline. They are usually not very passionate about the companies that they decide to buy, right? And so, they can walk away from a deal and eat $500,000 of deal fees, by trying to hardball you right at the end. They don't usually do it, but if they do, like you said, believe them. They are who they are.
Yeah, absolutely. Well, and I think that we've talked quite a bit about this topic, and I think the interesting part, though, is that I don't know if I really got until just now, is that the difference between a third, fourth generation and a first generation seller is that what we just talked about is probably more a first generation seller, sure, which is they almost have in their mind the price that they want for the business is the price that is the difference in what they have for retirement and what they need for retirement sometimes, right? Yep. And so they're really not placing the value based on the cash flow and the metrics like everybody else is. They're like, no, I need to sell this company because I need 5 more million to round out my retirement. Whereas multi-generation might be like able to just sit back and be like, if the deal happens, the deal happens, because I'm going to be fine either way. And so there's a less kind of, really locking in to right. that. So they give themselves a better capability of negotiating if you disconnect from that actual transaction happening until it literally happens. Yep. Because there's so much that happens in that last couple weeks. Like, I don't, and I've done much smaller deals than you have, so there's so much that goes on at the last minute that everybody's trying to scramble a little bit. In the bigger deals, I will see more so that the buyer will have some more negotiating leeway because they're doing multiple transactions, right? We've even been in transactions where they've been buying multiple companies at the same time. And it was almost like, well, if we bought you and them, great. But if we didn't, we locked in somebody, so you don't always know what's happening. And I think that we don't always want to ask those questions either, because they're asking us all these questions and we're just like, okay, we don't know what you're going to do with the company. And even if they promise you that they're going to do something with the company, that's not a reality. Once they get the keys, they could change the entire plan.
Absolutely. And bringing it back around to the multi-generational business, that's going to matter a lot more to somebody who's selling grandma and grandpa's business than it will to somebody who created it at their kitchen table with a resentment towards their employer 20 years ago. You know, that's like, it's just a very different dynamic. But you nailed it. You nailed it.
Absolutely. Well, tell us a little bit more about you and how people can reach out to you, because I think that if they've gone through this, I guess I didn't really understand the nuances. I think it's been really helpful to know that there really are kind of different things that we should consider when selling. There's, certain things that we would want to make sure we have the right buyer, and then making sure we connect with the right advisors. But, what can people reach out to you and like have an initial discussion with you if they're contemplating sale, or, what's the first best move?
Yeah, absolutely. So we only work with one kind of client. They're successful business owners. They're always selling founders. And the differences in the way that we work for them have to do with the time frame to selling, right? So we will help them. We're not McKinsey, Bain, or BCG. We don't help them create a better business. But we can help them build more value in their business or build towards a larger sale down the road. So our consulting practice is just on that. And there we will help them find another investment bank. We will help them build a deal team, will be as involved, or we'll hand it off, whatever works for them. The other side of our business is a boutique investment bank where we represent one or two companies per year going to market. We pick the ones where we feel the most collaboration with the founder. So it's not so much, look, we've done everything from fintech software to cannabis services to industrial, pumps to food ingredients to deep life science, healthcare services. It's not so much the sector expertise, it's the founder dynamic. Like if the founder and I have good chemistry around, he or she letting me know exactly why they want to sell the business. And I mean, at a really core level, why they want to sell the business. I think that I'm better at finding the right buyer when I know the seller's why than the other investment bankers that I interface with. And so, on our website that you've got there on screen right now, there's an insights section that has 200 videos answering every question you might have about the M&A process. They're searchable and they're categorized. And then there are multiple times on the site, there's a green button that says talk to Kirk. Go ahead and throw in whatever amount of detail you want about your business, and I'll get back to you right away with our answer. Some of it, is going to be, really, really private or confidential, in which case then we'll jump on a Zoom and we'll talk. But if it's a simple question about kind of process or something like that, we answer those all day long. And then what we did, because we got so much inbound traffic where the businesses weren't quite ready for our consulting services and they weren't ready to go to market, but still needed our help, we developed another business called EBITDA University. And EBITDA is earnings before interest, taxes, depreciation, amortization. It's the metric that most buyouts are done on, not all, but most. It's an annoying, arcane accounting concept, but you're going to hear it a lot if you're selling your company. So we embraced it. There, we train people on how to either sell their own company or what to be ready for and how to do some of the stuff that we would do for them on the consulting side within their company.
Well, and I think that is all amazing information. And we are endeavoring to do a series about a lot of these types of concepts, but also I thought I would mention this as well. You and I have talked about potentially having business owners come on, some sort of recorded or live communication where we work through like the value of the business, what it could go to market and things like that. So, there could be new things in the future that we talk about, but actually it's an opportunity for some business owners to maybe see in a confidential way, what they could sell for, what some of the issues are, and figure out if it's the right steps. But in all capacities, just sitting back and thinking, what could I do? And if you're concerned about telling, like your immediate circle or your immediate advisors, I think that there's an opportunity to reach out to somebody like Kirk or me that you can understand the value before you make those decisions. Like, this really is a process because it's beneficial for you to plan this. It's beneficial to get not just a better price. This is like selling your house. You just don't go and put it on the market and then sell all the contents as is and just walk away. It's a process to get really the right person or the right situation for you. And I like that you said, seller's price, buyer's terms, and vice versa. It's to get people around you that start making you think differently and making you prep for this next stage, not just put a sign on the door and say I'm for sale and hope for the best, right?
Right. I can't say it any better than that, so I won't even add anything to it.
Well, we appreciate you, and we will see you again soon talking about more business concepts. Thank you so much.
All right.